guys, Mike here. So, oh boy, we finally got our decision whether it's a 25 basis point cut in the market or a 50 basis point cut, and we got a 50. So that Fed watch tool is still right on the money. We're also going to go into what that means for the market. Also, we got a big Opex coming up for September. It's quad witching. We're going to list our friend Jim talk about that and tell us all about what that means and why it's such a big one. And of course, this means the money printing press is turned back on and everything. I love this meme. But there was one thing he said in the press conference, and I don't know if you caught it, but I know it vindicates a lot of you guys, what I've been saying, and it's just amazing that he actually said it. I couldn't believe he said it. I rewound twice to make sure I heard it correctly. But here was the key line from that press conference to me.
So since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down.
And so, yes, he knows, as I was telling members, the data coming in is hot garbage. It's not accurate at all, so they're expecting to come down, and that's why they did that 50 basis point cut, because if you look at GDP being revised up, the sales, like everything's getting revised up. You're seeing all this econ data come in positive all of a sudden for housing and industrial stuff, and manufacturing is all of a sudden better than expectations, which is kind of fishy to me. But anyway, you know, that one stuck out. So he's expecting this stuff to get revised down. And, you know, my favorite thing to do here is cue this roller coaster for those who did not see these market moves today after 2 p.m. And folks, I'm talking about massive moves. I did it on IWM because I knew that would be the case. But you're talking about 2.3% up. Then you're looking at multiple 1 to 1.5% drops and rises over the next hour and a half. I mean, it was just amazing to see it. And people are going to the moon. And nope, sorry. And it just slowly just trickled back down where everything closed red. The futures are actually trying to pump right now and get everything back green. We'll see where that goes. We'll talk about what to watch out for in the futures. But when you look at IWM, because you think to yourself, well, if it's going to affect anything, you think it would be small caps, right? You look at those wicks. That's horrible, by the way. But it got up to almost 225 today, which is crazy to think about. If you look, I mean, you know, a couple weeks back, you go, wow, it was looking terrible, right? But when you look at this, plain and simple, you have to see the bulls are still in charge. The RSI is above 50, right? And in order for this party to keep going, you got to get above that long wick right there, around 224.15, I believe it is. And then, of course, for this to actually start collapsing again, you want to get below that trend line. So if you're a bear, you want it below that trend line. If you're a bull, you want to get back above that wick. And you could see this coming into Opex and everything in September and all the bad seasonality we're in, just kind of go into like a 1 to 2% range, right, for the next couple of days. So keep that in mind as well, because this move doesn't mean we aren't going back to all-time highs. Doesn't mean we're dropping off a cliff. But when you look at it, once again, below it, wedging again, right? It's right in this triangle again. So that's 2 days in a row now where you look at a breakout. Nope, gets rejected, comes back down. And you see it right there, what I'm talking about. And so that is indecision, right? Like when you look, there's some fair value gaps on the daily that's sitting right here. So it could absolutely come down to the bottom of that trend line right there. Don't be surprised. That's not a huge move. But right now, in order for that to happen, the bulls got to lose it on the RSI, right? The RSI needs to get below 50, and that's when you'll see it happen. So watch that RSI carefully to see who's in control, because right now it's kind of like, you know, bulls are somewhat in charge for sure, and they've been pushing this up, right? But you can see on the S&P what happened. Got a new all-time high, got to that trend line, so I keep it there, and got rejected to the penny. All right, so this one right here, you know, yes, you got the new all-time high, but immediately sold back down. Okay, now again, what we got here? We got daily fair value gaps. We can try to mitigate if it decides to move down and stuff, so don't be surprised about that. But what's really key here is you look, here's your moving averages, right? So we're well above the moving averages. The 50 happens to coincide with support right there. So if it does drop down, keep the 50, you know, obviously on your calendar. But more importantly, what could happen if it moves up, you can see it do what it did over there. It just grinds up, right, on that trend line and stuff. That is the case, because once you get to all-time highs, there is no resistance, right? But more importantly, look at what you got going on here. That right there is a higher high, right? That's what that is. This right here is a higher low. So that is a trend still up, right? And really, more important, when I look at this, I think to myself, that is the ugliest looking triangle formation, if you want to call it that, that I've seen in a long time. But I mean, that's what you have, right? That's the points right there. And so again, could it come down the bottom right there, hit that trend line again, come back up? Sure. Or it could just break right through. I mean, that's what we're going to have to find out, because we keep getting up there and then just selling back down. All right. But again, we're in the last 2 weeks of September. We're going in October. We got a huge Opex coming up. All this stuff is happening. If you're looking at the futures on NQ especially, which is the one I like to look at, just what you're looking at here is this right here is relative equal highs. Look at all of those relative equal highs. The question is, which one are they going to take out first? The relative equal highs or these relative equal lows down here? And then with relative equal lows, don't mean it have to be exact, right? But in the same neighborhood. And that's what you're looking for, okay? And so we'll see which way they're going to take it overnight, which one they're going to look for to take out first. If you take out the relative equal highs, odds are you're going to get a reversal, come back down, start grabbing liquidity down below, and might even take out these relative equal lows. Just mark out your prior day's high, prior day's low. Whichever one gets taken out first, we're probably going to see a reversal in the opposite direction. That's what you're really looking out for here. And again, this is going to be all about positioning for Friday's Opex, right? Quad witching, all this fun stuff. So just kind of keep that in mind when we go through this. Now, a couple of you guys asked about certain things, and one of them was XBI, right? Because it's rate sensitive. And you look at this, and you got this triangle formation, could break either way. Most time when you see it banging up against the top right there and setting higher lows, you'll see it, head north, right? You see the target and everything. Right above this, about 10% above this, is a weekly fair value gap. This could be a magnet for it to go up. If it does go up, to mitigate that, it's about 10% above. The target's way above that, like 130. You see the target below is around 75. Again, these hardly ever play out to what the actual target is. But XBI is going to be interesting to watch when it comes to these rate cuts and stuff, okay? Celsius, somebody asked me about. I don't know why. Again, this is hot garbage, down 68%. Total momentum stock. I don't have to pull up any momentum indicators to let you know, and you don't either. That has no momentum, okay? That has no momentum. But here's the key. Here's the key, right? What you're looking for if you're in this thing is the weekly moving averages, because the daily moving averages are way above, except where the 50 lines up, and I'll show you. But you have to get above the weekly 200. It bounced off before, fell through it, and now it's approaching it, okay? Also with a resistance level, which used to be a support level. And so that's key to look at right here. And once you get above that, then you look at the 100 weekly right there, along with that trend line will be resistance. That's kind of a ways above, though. If you pull up the weekly, you'll see what I'm talking about with the 50 moving average. You see it pointing straight down. And that right there lines up right above where that 200 actually is. So when you break above that, the 50 is going to be hit as far as resistance. So just, again, you need some momentum to get this thing going, okay? It's been destroyed. And certain things to look out for are stocks like this. The high flyers. See if the high flyers, high beta stocks start to run. If that runs, that lets you know, yes, it is risk on. Okay, it is risk on, which means everything's probably going to move up. That's just the way it is. If that stuff doesn't start moving and you're seeing yield spike again and all that fun stuff, and also watch for defensive stocks, utilities, healthcare, staples. See if those start to move up. All right. So if you see all the defensive moves up and the high beta stuff isn't and the Mag 7 isn't, that's kind of a red flag, right? But if you see high beta stuff start to move up, then you know it's risk on, right? They're like, oh, this is great. We're really accepting this, rate cut stuff. It's a soft landing, all that blah, blah stuff. Now, the housing data, this is interesting right here. Keep paying close attention. Another data point that came in, oh my God, much better than expected when it comes to housing units, total housing, all that good stuff. Now, pay attention to this when it comes to the job market, though. Construction backlog is clearing. And so you can see these are housing starts versus completions versus in the middle there is the under construction. You see that's been dipping over for over a year now, the under construction part. And you're seeing obviously the other two right here where they're heading and everything. But what's big about this is what you see over here when it comes to the jobs data. A lot of people are in the construction business, right? And you're seeing the residential construction employment right there, not dipping at all, but units under construction have took a major downturn, right? And normally when this happens, you'll see in the other instances here, it leads. It happens before you see construction jobs go under. And these are good paying jobs, okay? So that's why I want us to watch it. We'll pay close attention to it. Again, that could take months to actually work out and everything. But I want to obviously pay close attention to it, because when you see that, not a good thing at all in any way, shape, or form. Now, let's listen to Jim Carson here tell us why September Opex is such a big deal.
SEP Opex is a big Opex. It always is. It's a big part of the seasonality of why September is such a bad month historically, right? And SEP is bad, but if you look at mid-August to mid-September, it's even worse, right? That's really that expiration cycle. That's an issue. Quarterly expiration cycles in general can be very stressful, but they tend to, in other months like December and June, tend to be positive bias with fat lift tails. And that's because you have a lot of holidays you have during that period that accelerates times, and you have other effects. Like in December, at the end of December, you have a reinvestment effect. So if the market's already up, you have a massive Jan 1 re-leveraging money coming in. We've talked about this on the show before, and all of those effects come together to make December a very, mid-November through really mid-January, that 2-month period, the most positive period out there. September has this fat tail. It has this vol that other quarterly expirations has, which makes it very volatile, and it doesn't have the benefits that Jan 1 flows. It sits on the other end of summer, where volatility is historically very low and compressed, and so it actually is driven by a lot of increasing volatility, right, as you come into the fall, as people come back. And so that pressure on volatility in the context of a lot of open interest in that SEP Opex tends to create some reflexively some volatility and some real tail events. So if you look at the distribution of how many times it wins versus loser, it's actually not that bad. It's just that when it loses, it's really bad. And I think that's really important to the story. So this time is no different in that sense. It is different in a couple of other senses, though. We have an election. So election years create a bunch of event vol, a bunch of risk behind September, when normally that's well supplied in November and December. And so that event vol in November makes it even more stressful, because you can't hedge behind that September as easily, and it creates more open interest in the back half of the quarter, and so more kind of tail interest there as well. So you take all of that in the context of kind of what we saw starting in August. That got started really in mid-July with a rotation out of the AI names that was driven by, again, not many people would agree with this, but this is my view, is driven by the option market primarily. You saw a 4 standard deviation move in July and late July between the Russell and the S&P, and that S&P underperformance was primarily driven by AI underperformance in the Mag 7 broadly, and so that really started to break dispersion in the market, and this massively leveraged dispersion trade we've talked so much about, and that stress in those parts of the market eventually led to a deleveraging in the broad market, and then started creating stress in different pockets like yen, the yen carry trade, and other things that really started to kind of break as vol increased, right as we're coming, like I was saying, out of the fall and into that SEP Opex. So it's never the same exactly, but it always kind of rhymes, and the factors that drive that leverage, that tinderbox there in September are there and help really make the odds that we have, higher, that we have those kinds of events.
And here's what's interesting about that, guys. Here is S&P 500 September quarterly option expiration performance of 1982. You know me, I could care less about going that far back. But you see the first column is the expiration day, then the week, and then the following week, okay? And when we scroll down here, you'll see right here, I'm just going to go back over to 2014. And all I'm going to do is point out the green stuff, okay, which is far few and in between. But like I said, when it goes really bad, it goes really bad. But most time, it just really doesn't go that bad, okay? That's what you're looking at here. But you can see these arrows. There's not a whole lot of green in the day of, the day after, or the week of, and the week after, and all that stuff. Not much. Most of it's red. But when you're looking for major like moves down, you don't see crazy stuff right going on in here. But you do see red and probably a lot of flattish stuff going on, right? It's a lot of flat stuff going on while the market, sit there and, rebalances and does its, yearly freaking tax loss harvesting and all this fun stuff. Don't forget, obviously, the stock buybacks have stopped for a lot of companies and stuff. And so I at least wanted to show you that, to what to expect and everything. It will create volatility, no doubt about that. Now, of course, tomorrow, we got unemployment claims, which I guess we can't trust, obviously, according to the Fed president. Philly Fed Manufacturing Index. Let's see if this comes in higher than what people expected. Existing home sales, CB leading index. Also, and then earnings, we will have some actually important earnings to pay attention to. Darden Restaurants, huge restaurant company. Cracker Barrel, and then FedEx, because, for whatever reason, transportation seem to be doing really well. And then Lennar, the home builder. Okay, so we'll get to find a lot out tomorrow on those earnings calls about the consumer, as far as we're buying houses, how transportation is looking, Darden Restaurants, are we still eating out, and what group of people are eating out. Because normally you'll see them say, well, if it's X amount of dollars or below earners, they're getting crushed. And then, middle class up is doing great or something. That's usually what you'll hear them say, but let's just see how that goes. So anyway, I know it's a lot of information. Hope you guys got something out of it. Please hit that like, subscribe button as always. Feel free to put your questions in the comments tomorrow. If you got any questions for Saturday's video, feel free to sign up for the membership, which I know a lot of you have. Really appreciate the support and everything. Let me know if anything I can do for you or add to that detailed morning news brief. And besides that, I will see you tomorrow. So please have a wonderful night.